If we look at the external directional bias, we are going to see a price action pattern of an uptrend. Essentially, a price action that has a push to the upside, which is the first movement. The pull to the downside is the second movement, and continuation with another upside push, which is the third movement. The point of the third move is to break the last high, so the market can continue the uptrend. The break above the high is a break of structure on an uptrend. You might have seen this notation on my channel, and maybe on other ones as well. But what's important is to mark the upside breaks on uptrends, because if we got an upside break, that means that we got a higher high, and the higher high is a swing point of an uptrend. So you make sure you know the trend the market is following. When you know the trend, then you know what you should be looking at. On uptrends, the key points are the pullbacks. They are the downside movements, because this gives an opportunity for buyers to enter at a lower price. This pullback should many times end on a demand, and you will often see that it will. Let's see here, for example, on this pullback, and especially where it ended. So the moment the market stopped dropping down and actually started the upside movement once again, which is the movement that caused the break above the last high. This exact point should end on a demand that was formed on its left, basically around the first movement, which was the initial push to the upside. Either from this time frame or from another one, a demand needs to be found. We can zoom into a lower time frame as well. For example, this is the same price, same market, just seen on the 5 minutes time frame, so the same price shared across more candles. This was the moment the price stopped falling, and the moment it started going up. And if we look on its left, on the first upside push, we will likely find a demand there. The demand is found on the last downside movement, and more specific on the last bearish candle, right before the market started to significantly push to the upside, and we can check that pattern. Right here we got that downside movement, that was then followed with a quite aggressive upside price action, and so we check the last bearish candle before that upside impulse, which is exactly this candle right here. This is the demand, and since it's taken from a lower time frame, I call it a low time frame demand. And we can see that the high time frame pull to the downside ended right on this demand, which continued to the upside after hitting it, and that was the third big movement that caused a break of structure from the high time frame. Now, after creating the high from that upside push, the price pulls again, and then it continues with another upside push that breaks above the last high. Basically, it has done the same thing. And this downside pullback probably also ended on a demand that was taken from a lower time frame, similar as we've seen on the last one. But what's most important is that we got a break to the upside, so it held the uptrend. Now, if a similar thing happens, which is basically what needs to happen for the uptrend to keep going, is that we should see a pull to the downside. And our key goal is to find with approximation where that pullback should end. And exactly like we've done before, the pullback should end on a demand. And on this time frame, we actually have the demand on this low, the demand being the last bearish candle before the significant push to the upside, also being the same upside push that caused the break into a higher high. So essentially, if the uptrend keeps going, a similar price pattern should happen, meaning that we should see a pull to the downside that is then followed with an upside push into breaking the last high. If we use the low time frame during this downside pullback, we can spot the moment the market ends the pullback and starts pushing up. Right now, we're on the 5 minutes time frame. Right now, we're seeing the moment the market created that high time frame demand, and we can see the details from the low time frame. For example, if we analyze this price action, here we have an upside push, a downside pullback, and an upside push that broke above the last high into a new higher high. So this movement in itself leaves a low time frame demand, which is the last bearish candle before the market started to push to the upside. Now, after setting the high, again we have a downside pullback that is also quickly followed with a push to the upside that breaks the last high. This also leaves a low time frame demand that we see that the next pullback is hit and respected since the price bounced to the upside after hitting it, and the bounce is basically a push to the upside that yet again broke above the last high. This demand liquidates and becomes inactive since it has already filled. But from the upcoming price action, from the fact that we got another downside pull and upside push, it leaves another low time frame demand that again filled from the next downside pullback, and was then followed with a push to the upside, breaking the last high. So if the demand filled, it liquidates and becomes inactive, but because we had the same pattern coming up next, so a downside pull with an upside push, it leaves a new low time frame demand. Now this low time frame demand invalidated, the price breaking it down. If the demand broke down, that means that the last low also did, So this price action went from holding an uptrend pattern of higher lows into now having the first lower low. That means that this trend is more than likely reversed into a downtrend. But this downtrend is actually just a pullback to the downside from the high time frame, so the market can fill the high time frame demand. So in other words, the low time frame follows a downtrend, but this downtrend is only a pullback of the high time frame trend, and right now the price hits the high time frame demand. And soon after it hit, we're starting to see how it's pushing back to the upside and breaks above the last high. So we went from forming lower highs into having the first higher high. A higher high is a swing pattern of an uptrend. So it's quite likely that this is a reversal from a downtrend into an uptrend. So basically the low time frame trend is entering an uptrend, which means that it starts aligning with the high time frame trend, which also follows an uptrend. On uptrends, we have this pattern that leave a demand zone. The demand is found on the last low, and we will look for a downside pullback to fill this demand and take the market into uptrend continuation by breaking the last high. Now, if we apply this into this chart, inside of this low time frame, we look for the low and we identify a demand there, being the last bearish candle before the market broke to the upside. And this is a low time frame demand that is inside of a high time frame demand. They work in confluence. More confluences mean more validations, and more validations increase the quality of the setup. Also remember what we did right at the beginning. If you remember, we mentioned that these pullbacks usually end on a demand that was taken from the previous low from the left. And if we look at this low, and more specifically on the left of it, we will see that it fell down right into the demand that we found when beginning the analysis of this low time frame, which is also the only demand that was left unfilled. And it's right on this demand where the pullback ended and bullish action started coming in, and because of the bullish reaction that printed the same pattern, it left another demand. So if we expect a similar thing, and it's probably a better idea to trade with the trend instead of trading against it. If a similar thing happens, that means that we get a pull to the downside that fills the demand, and we look to get a bounce to the upside so it can continue the uptrend. So that means that it makes sense planning a buy setup from this demand, the stop loss below it. And for the take profit, structurally it makes sense to place it above the last high. In this way, even if the market breaks the last high, but then reverses into a downtrend, we would still be out of the setup before losing it. That's basically placing the take profit based on the internal price action. But since we are in a high time frame uptrend, there are higher chances this upside push can break above many of the previous highs. For example, if we target the second internal high, we get a 2.5 ratio, which is what I usually preach on this channel. But if you only care about the theory, because the market is in a high time frame uptrend, it makes more sense to place the take profit above the last swing high. That's the extreme high from the high time frame, and this would increase the ratio to 3.5, which is kind of more risky. Theory helps, but theory will not always respect. What we could target the most without being too risky is at most a 3 ratio. That also coincides with a break of this high. The pullback begins. It hits into the low time frame demand that's also inside of the high time frame demand. So far it's bouncing to the upside, breaks above the last high, slowly pulls down, and continues the upside push, hitting on the take profit. That's how you get these high-quality setups. You find confluences. It takes time, and as you've seen, it also takes a quite advanced way of analyzing the price action. It's not easy at all, but the analysis is what makes it so much more simple. That's mostly on what we're focusing on our system. You might take a look at it on the description. Also, if you find it useful, make sure to watch more of my content. I'm sure it will be helpful. Thank you for watching.